Hello. Good afternoon, everyone, and welcome to today's webinar. The topic is Career Insights on Private Equity and Early Stage Investing. This webinar is hosted by the CFA Society India and CFA Institute. My name is Rajiv Radhakrishnan. I am the moderator for today's session. I am currently working as a Chief Investment Officer with SBI Mutual Fund, and I am a director on the CFA Society India board. I'm in charge of the Career Services Committee of the society. I've been on the fixed income space for more than 20 years. I have an overall experience in the financial industry of about 23 years. So before I introduce the speaker, just wanted to give a brief on a couple of housekeeping notes with respect to this session. Today's session would be for a cumulative time of about an hour with about 15 odd minutes we can have for Q&A. So we would be leaving sufficient time after the presentation for the question and answer session. So please feel free to submit your queries as the presentation is ongoing. So you can click on the Q&A icon at the bottom of the screen and post your questions out there. Let me now introduce today's speaker. The speaker for the session is Naveli Jain. Naveli is the VP Investments at Ankur Capital. Ankur Capital is an early stage VC firm investing in digital and deep science technologies. So Naveli is a dynamic investor with a passion for investing across the risk spectrum from early stage VC, that is early stage venture capital, to late stage private equity. She currently leads the investments in digital tech solutions for manufacturing supply chains, B2B logistics, and healthcare. She's got an experience in the financial, in the BFSI sector, the majority of which has been in private equity and venture capital investing. Naveli has executed equity transactions ranging from fundraising for early stage companies to buyouts, JV partnerships, as well as stressed asset investing. Her professional journey also has included collaboration with institutional investors such as CDPQ, Alliance, as well as strategy and business development. So she is a seasoned professional in the investment landscape, and I'm sure the participants would gain a lot from the session today. So over to you, Naveli. You can take over from here.
Thanks. Thank you so much, Rajiv. And thank you so much to the CFA Institute for having me here. Pleasure is all mine. Just excited to be here, participate in this conversation, have a chat with the young audience out there. So yeah, thank you so much for having me. Maybe what I'll do is just to start as the audience kind of picks, and I'll just start with an interesting insight. Sorry, I'm just facing trouble with, yeah. Okay. So the way I plan to craft this out today for the audience that we have is essentially to walk you through what exactly does investing mean. I'll try and keep it as simple as possible so that people are not really confused with so much jargons that kind of lays around with this whole investing word. We'll try to keep it basic so that you follow in terms of your career insights and your paths as well. Then using the two life cycles of both your fund and your investment, we'll try and walk you through the different segments of this whole journey, right? And I hope that kind of helps you make your decisions better. So maybe just give it a twist, and I'll start a little lighter note just what's the first instinct that you kind of get when you see this graph, right? There's a lot of jargons, but I'm sure there must be a lot of excitement, anxiety as well, and a lot of nervousness and stress as well. So can we just have a quick poll just to kind of, for me also to kind of coach the audience in terms of how does this slide actually make you feel? Okay. Interesting. I thought maybe people would be both excited and intimidated, but it looks like we have a very geared audience here. I see two-thirds of it as actually excited. So great, thanks for that one. And just a quick one before we kind of move on further as well. Just one more quick question. Here we have a lot of names here, a lot of companies, which both private equity and venture capital. But if you kind of get some sense in terms of, what is it that I'm trying to depict here? And we will walk you through this over the journey. But in terms of what is it that the X and the Y axis are also trying to sell you, what's in it for the company, the life cycle and stuff like that. Well, great. It's interesting. It's interesting to see that we have a very, very informed audience, and I like that. So, okay, so 75% are well versed with this one. So maybe I will not spend a lot of time in the next one, and you have actually eased me out there. But essentially, what I'm trying to get over here is I'll walk you through the exactly what the life cycle of a company looks like, right? There might be an idea or a concept, but to kind of get that into material and action, you need some kind of capital to kind of onboard and start that process. So that's where the whole journey of a friends and family with a startup kind of starts. But that capital might not really be sufficient for you to kind of reach to the next level of your growth, or even figuring out growth comes much later, but figuring out what is the product that you want to offer, what is the product category, your market, your GTM and stuff like that. That's where your journey starts eventually with, because so currently you move from friends and family to you move to your angel investors, right? But this is essentially where the early stage investing kind of begins. And the first institutional equity money kind of comes with your venture capital investments. These are essentially across the spectrum of early seed, pre-seed, seed to pre-series A and stuff like that. Many jargons there. But essentially what they are trying to do is when founder has a good idea, it has got a huge market, and there is some kind of maybe a PMF existing or no. There has some kind of business model. It may or may not work. So that's why we have different kind of investors sitting in different buckets. And a high risky kind of a profile is where venture capital investor kind of comes in, right? They typically hold minority stakes. They are not really majority investors, but it's a lot founder driven, and there's a lot of conviction that one needs to get comfortable. It's essentially a founder's bet as well to a greater extent, right? But as the company goes on through their journey, as the PMF, the whole GTM, the business model kind of stacks up, but the company might not really be profitable. That's where it requires even further growth capital for it to be a little more, for it to have levers and capital for to grow and expand further. It's about repetitive execution at that particular point, right? So you have a little more sustainable returns and dividends at that particular point of time because you're moderately risked as compared to the high risk of venture capital, which comes in because the survival rate itself is question mark there, right? So post that growth stage, wherein you have invested with a moderate risk, comes the private equity stage. Private equity stage is a little more matured kind of companies, and these could include even your minority stakes or your buyouts or strategic buyouts and stuff like that, right? But these are essentially more profitable. Your financials look a little more stabler. Your market fits and your businesses, everything, it's a little more streamlined, and it's about actually further aggressive growth and stuff like that until and unless the IPO market kind of gets hit, which is your public listing, etc. But having said that, right? So it's right now because we are here to kind of understand from an institutional standpoint where the venture capital and the private equity kind of stands in. Simple slide, but essentially what I'm trying to capture over here is there are both similarities and differences in this investing. And please appreciate that fact that in your PE and a VC world, what we essentially see is both of them have institutional capital at the end of the day. They both are private money, which has a fiduciary responsibility of working under the set construct of a particular fund and has to return back the capital at a particular life of the end of the fund, as compared to maybe your IPO, which is more private money, public money, sorry. And this is more in terms of the private investing landscape and not really your friends and family or other kind of non-institutional money, right? So having said that, just as a basic level, what exactly on a venture capital and a private equity perspective. So as we discussed, one is very early stage and one is more towards growth to mature stage is what we are talking about. And hence, since you're taking very early bets in these venture capital firms, your risk return matrices are really, really high, right? So your return expectation, because of the risk that you kind of take, businesses will not survive and stuff like that, your risk matrices are really high as compared to your private equity. And hence one of the reason why your portfolio, the way you kind of end up constructing, right? You might take minor bets in a bunch of companies because you have to construct your portfolio in such a way that you know for the fact that certain particular percentage of your portfolio might not really provide you that kind of returns that you have promised to your investors. So because survivability again is a question when you're talking about venture capital, right? So typically, the venture capital investors, the fund would typically have a larger number of companies constructed in the portfolio as compared to probably private equity, which will have a fewer set, more targeted kind of investment approach and thesis, right? And that's why the typical ticket size would also vary across the funds. And the degree of control, right? In a venture capital, the the subtle difference that you need to understand is, I think, when you're going in early, right, you are not just a financial investor. There's much, much more value add that you do in a company because these are really nimble companies at the point when you're investing. You need to actually work out sometimes the strategy with a founder in terms of helping him navigate through his journey. He might be stuck up somewhere. You might help him with just maybe recruitments. He's in he's growing his business. He's stuck with CFO person, right? Or he's stuck with an HR person. So as businesses expand, as he enters into different geographies, you actually have to do a lot of hand holding, if I could say so, but essentially work along with the firms that you have invested in, a much, much more deeper engagement in a venture capital fund. And in private equity, it relatively is lower, but depending on your stake, if you're owning a majority stake or if it's a buyout, then it's a completely different story. But yes, relatively less engagement, if I could say so. Your board seats and all of that definitely is there. But I'm just talking in terms of strategic level, more ideation, initiation, and discussions and talks that kind of goes in your early stage venture. Having said that, maybe shifting gears a little bit, most of it that we understand here has been from the equity landscape, right? And that's where we hear a lot of in terms of private equity and venture capital. But I think I also want all of us to think here holistically in terms of um, investing is not just about the equity investments. Both PE and VC have its own set of debt investors as well. And all of them cumulatively play a very important role in the growth journey of a company. So debt again can be both venture debt and your private debt. So different kind of debt players sit across the spectrum of the growth of the company, right? So that's important to understand as well. So just quick highlights. I think this is a little more basic in terms of why equity investing versus a debt investing, because even in a venture debt will not really come in at a very, very early stage, right? Because you need to kind of have some consistency on your cash flows. Because once that is kind of built, then the lender would be essentially be more willing to kind of lend you money with providing you some flexible repayment terms and stuff like that, right? So it's important to understand that equity investments, while are not really looking for a periodic repayment, they are ideal for a startup. But at the end, please do not look at it as a free money as well. I think that's where again a misnomer kind of lies in terms of early stage investing. Ultimately, the expectation for a return is much higher, and that needs to be delivered over the course of the life of few years, right? But equity money also helps you when you're maybe over leveraged. That's where equity money is essential because your numbers might not really stack up that time. So, and when you are able to service, then probably you want to just, if you're able to service your interest payments or cash flows a little more consistent, you want to prevent your dilution, and for rightly so. So when you have reached to a particular growth milestones, a company will look out for both venture debt and your private debt. So that's where it's an interesting flux and a mix. And whenever you're looking out for options and you're thinking about the whole investing space, I would urge each one of you to kind of think from a cumulative standpoint because all of them are needed in this growth trajectory. Okay, now just trying to understand this from the perspective of essentially the life cycle of the fund, right? Because there are various roles and nuances that one needs to cater to over and above the investing as well, and the complexities associated with it. So for just a graph, which will essentially help you understand in terms of the different aspects of a fund. So fund formation by itself is a very complex thing, right? It depends on the strategy which you the first once the strategy itself has been chalked out, right? You need to think about how your LP base is. Is it more domestic? Is it more international? Where do you want the fund to be housed? Then there are these regulations. Your AIF regulations will kind of kicks in. The documentation, that aspects that needs to come in here. And over here, it's a complex chain of both the in-house teams and your consultants who kind of play a good role together to kind of help you enable form your fund as well. So that's why a lot of things with regards to your accounting, taxation, your legals, etc., all of that kind of comes in here as well. Once your fund is formed, and the most important aspect, I think all of it important, but fundraising is again a very, very difficult and a nuanced aspect, right? Because essentially this is where the fiduciary responsibility starts to a much greater extent. How do you ensure that the capital that you have kind of risen, and reach out to the audience over there, promise them certain under the set boundaries of the fund construct that you'll be able to deliver to them, right? So again, multiple roles, as you would see, that kind of pans across this particular segment as well, because it's about presenting, preparing your documentations. It's about roadshows. You're going out in the market, talking to people. And once they are also there, going through the whole DD process, making them convinced, making them comfortable, then the documentation aspects, right? So there are these bunch of other activities which also lies along this raising of capital stage. And moving on further, once the capital is risen, and there are these other nuances of first close, second close, etc. But essentially, once you have risen your capital, you get into the investment mode, right? And investment mode is essentially where you start deploying the funds that you have risen under the parameters of the fund, right? This is where I would actually segregate two kind of roles kind of comes into, right? So one is the pure investment role by itself, wherein you are actually sourcing the deals, you are evaluating the deals, you are going into depth, you're having conversations, and the role and the life will vary across PE and VC, but it's just typical one essentially is to do with the different aspects of investments, right? From your sourcing, your evaluation, getting internal resolutions and, discussions, then your DDs and stuff like that, which we'll walk later. But essentially, this investment period has a critical role of an investment team, but it also has a very important role that needs to be played by other part of the team members, right? Which is essentially to do with a lot of your fund NAVs to be calculated. You have a fiduciary responsibility again to kind of report back to your investors, make them informed about what is it that the fund is doing, how is it performing on a quarter by quarter or a 6 monthly basis as per whatever the documentation and the fund terms are, right? So a very complex nature in terms of just one is at a deal level and one is also at a fund level. Terms of just monitoring your fund financials, your taxations, and your providing NAVs and reporting. So a complex bunch of stuff, both from an investment and a non-investment perspective, right? And even post your investment, it is a lot about monitoring. Once the fund is deployed, you continuously, the investment team will need to kind of monitor in terms of how the performance of this investment has been. And as I said, right, your venture capital might have a closer linkage and much, much deeper discussions on a much more periodic basis as compared to the others. But yes, so that's where investment along with monitoring kind of comes into picture. So at the end of your investment period, or when you see that the particular company or a portfolio has been performing in a certain category and you become comfortable, you also look out for divestments, right? Because ultimately at a portfolio level, you need to kind of return, take exit from those investments to kind of return back the money and the returns that have been promised to your LPs, which is essentially the liquidation stage. So divestment and liquidation, essentially then it would require the role of not just your investment teams, but also some funds. It's a very structural thing, right? Some structural teams also have a separate exit teams. Somewhere it's a portfolio team, which is a separate one, which also guides in the whole divestment process. It could vary across fund to fund and the stage as well. But essentially, then you are divesting your deals. And that time, again, there's a lot of things with regards to your compliance, your legal, all your taxations, etc., etc. And all of that cumulatively kind of comes into picture from a divestment and a liquidation standpoint. So I think just so that was just to provide you a broad construct in terms of the different roles once you're talking about your career as well, in terms of what is it that you can look at and where does it all kind of stack up at a holistic picture, right? Um, the another purview of this one that I would want to walk you through and help you understand again on the different paths that could lead to in this whole journey of PE and VC investing, right? Is once we go through the deal life cycle by itself. So this is again a typical deal life cycle, and this might vary with regards to even the roles and the a little bit here and there with from a fund to fund or a PE to VC perspective, but this is like a typical deal life cycle that you would see. So what we see here is once the thesis, the broader thesis of the fund is kind of made in terms of which sector you would want, what's a typical deal size that you would look at. Do you participate in follow-on rounds, or to what extent, what's the kind of shareholding pattern that you look at? What stage do you come in? And a bunch of other questions, right? So once that investment thesis has been formed, it's a lot about deal sourcing as well. You source your deals and then you evaluate it. This is primarily a lot internal dependent, but it requires your deal sourcing is also a lot about the external stakeholders, which is where all your consulting and investment banking firms also comes into picture. And that's where this whole ecosystem has to be really conducive and providing you a lot of different opportunities apart from just looking in silo as a PE fund or a VC fund, right? So these investment banking firms and your consulting firms will essentially also enable you and help you ideate, will help you deal source your deals from the perspective of investments. Once you get a little deeper, you will evaluate that with your internal stakeholders, external stakeholders, and stuff like that. And once that is kind of done, right, you will kind of then have a sense on your valuation and your structuring. And this becomes typically important because how is it, which instrument could be best leveraged for a structure? Is it a priced or an unpriced round? Is it an India deal or is it an international deal? How do you kind of look at your FEMA rules and other regulations and stuff like that? That's where a lot of teams might even have your internal teams who might help you out with this, but a lot of your tax consultants and CA firms, a lot of intelligence and collaboration actually comes from here, right? So just to help you kind of structure this in a much more fruitful and an effective manner. Once that is kind of done, you also move a little deeper. When obviously that's when you get more comfortable in terms of that deal, and you are looking at actually deploying, and you want to head your gears even faster. Then you kind of go into the due diligence aspect of it. TDs could again from firm to firm, from fund to fund, from stage to stage could vary, right? But essentially, you're looking at a lot of financial, your tax due diligences, your legal due diligences, your forensics on the founders as well, which is very critical, your ESGs, your operational and your commercial due diligences as such, right? Because you're taking a call on the future. It's not really at the present. You're taking a call from the point of view of your investment, how that will pan out over the course of the next few years. So that's where you work very collaboratively along with your investment teams. The investment team works with a lot of these different consulting firms to kind of seek input, advice, and information from them so as to be able to make a better, nuanced investment thesis in that particular investment of theirs. So once you kind of get a little more in terms of what are the risks that you look at here, you kind of navigate through that risk through different mechanisms in your documentation if you want to take a call on moving ahead on that deal, right? So documentation is again a complex process in which there's a lot of negotiation that happens between the different parties that are assigned to it. And this typically will use the corporate lawyers from the point of view of etching out all the complexities, the permutation combinations with regards to what if things happen XYZ way, what if the other thing happens and stuff like that, right? That's again a complex piece and has its own set of course. That's where you get a lot with corporate lawyers. So once that is done, you're essentially looking at a lot of deal closure, um, which is to do with all your CPs that needs to be fulfilled, the regulatory aspects to do with it, and then you're actually funding and disbursement that kind of happens, right? But as I said, the deal does not really stop there. The buck doesn't stop there. You actually have to move a step further. And then you have to manage the portfolio as well. And which is where a close monitoring on the how the performance of that particular fund has been has becomes really, really critical, right? In terms of your MISs that kind of comes in. Obviously, you're on the board, but if any help, strategic help that's needed from a hiring perspective or from a strategic flow perspective, from a GTM perspective, new geographies that one wants to look at, any kind of help that a particular founder would need along its course of journey. And then also comes the last stage of it across a couple of years when it kind of reaps a benefit. You kind of look at the exit point of view. And exit, again, would need a lot of different stakeholders in terms of, again, investment banks and consulting firms kind of come in, which will help you to kind of scout through for where the potential opportunities could lie. It could be either strategic or it could be, through different other funds as well. So that's where it's a whole bunch of process in terms of, and it's not just an individual thing, it's liaising between a bunch of different complex parts coming together in terms of consulting firms and investment banking firms, and a lot to do with your tax, lawyers, your operational parameters and stuff like that, right? So it's a cumulative, comprehensive, and all of them have to be working in sync so as to be able to make this thing essentially more fruitful. So just keeping it short, I think what's important then, right, from the audience here, just to understand how do they kind of look into this. And we have also discussed here in terms of the different roles that one could think about as you now start through your journey and or if you've already started, you're charting out your way through the whole career, right? So I'll just divide the whole competency scale into two larger buckets. Essentially, one is your technical skills and one is your softer aspects. Right. So from a technical skills, and these could vary to degrees of requirement in a PE versus a VC, because the requirement, the needs of the skill might vary across the spectrum. But essentially, a lot of market analysis, intelligence, market trends in terms of the sectors that you're looking at. So you should be able to do a lot of data accumulation. And just one quick caveat, this is only for early core capabilities, right, that you need early on in your growth, earlier in your career. And this is not really from a senior level position point of view. So just with that caveat. So a lot of market analysis, intelligence, being able to spot trends, being able to see navigate through, maybe able to draw linkages, etc., data collection, and analytics on top of it, right, becomes really, really core to this particular kind of role. PPT and Excel skills goes without saying. I think that's like a must in any kind of role that you look at, right? And your accounting skills, your financial modeling, I think are really core to it, because ultimately you are evaluating a company for an investment standpoint. So you should be able to read those numbers very well and read and maybe draw a story out of it. Try and understand more from a trend perspective as well, right? Just don't look at it from a silo point of view, because you're looking at it from a future point of view. Understand the trend that's been picking up in that particular company over the couple of years, over a few quarters, and then maybe from a forward going point of view as well, or from the industry peers, where do they stand versus the industry peers of theirs, right? So all of that becomes really, really critical. And modeling, essentially, then your Excel skill also kind of picks in. Then by role specific skills, what I essentially mean here is so most of the skills that I'm talking of might be primarily from an investing standpoint, but role specific, I mean, if you are a tax consultant, right, your understanding or your nuanced aspects in terms of maybe your regulations and from just a FEMA, how does that kind of affect if my structure is in Singapore versus India versus an LP is foreign, domestic, even within domestic, how do you kind of make that transactions happen? So it's very, very rule specific. If you are into the documentation, the lawyer side, it's that kind of rules and skill set that you need to adhere and understand. And that what I mean is here more nuanced from the point of view of the PE or the VC investments that they're looking at, right? It's not just a random understanding at a top level, but a fairly detailed understanding in terms of a new with regards to the nuances of investing, right? What instrument might make sense? Why this? Why not that? And stuff like that, right? Valuation methodology is very, very important. How do you ensure that from a return perspective as well, what are the current valuation methodologies being used in a particular industry at that particular stage of a company? So getting really deeper into this will really essentially help you to make your case as well, right? So that's where we stand with regards to technical aspects, but also it needs a good blend of your soft skills. Because ultimately, as we said, right, this is not a one person's kind of a game. It's an ecosystem play at the end of the day. So your oral and written communication skills are absolutely has to be like spot on, right? Because you're dealing with multiple stakeholders. How do you kind of enable a better conversation, try and get to the nuanced point that particular person is trying to make and stuff like that, right? And you have to do a lot of negotiations as well at the end of the day. But early on, I think a very key critical aspect is just the eagerness to learn. How much you want to learn, how much you want to kind of get and grasp as much as possible from not just what is it that you're trying to do being in your silo, but also cumulatively if you're trying to kind of stitch the dots together. Your eagerness to learn, I think, really, really makes a lot of difference. Early on, I think in a VC world, I think founder assessment is just the core. It's not that it's not important in the PE, but in the VC world, you're essentially betting a lot on the founder, much, much more, right? So when you're starting having the conversations, and typically as an analyst and an associate, you would start that conversation very, very early on, right? Before the senior folks kind of loop in. So just trying to assess in terms of your discussion with them, with this kind of fit, will this work from, your fund point of view and stuff like that. Eye for detail, I think, is really, really critical because just simple example, like when you're looking through the number, are you able to spot a trend there? Are you able to spot a gap? Are these numbers speaking something? And all these numbers speak a lot of stuff. So I think it's just important for these details to be etched out. The earlier, the better, because the risks are visible and you take a calculated risk on the investments that you're doing, right? Networking, I think, is the most is one of the very few critical ones, I would say, because um, essentially in the networking in the VC world, you are out there networking with a bunch of other of your peers, and you are out there in the market and also discussing a lot with the founders, right? Your ability to source it has to be much, much more higher. So networking, I think, has to be a very, very critical and important aspect. And that's why I also want you to think if you're really, what kind of personality you are, right? I think that becomes really important. Are you just a more technical focused, you're really good in number crunching and stuff like that? Or are you a more of an outward going person? Because it requires a lot of these skills with regards to going out, having open conversations, reaching out to unknown people and stuff like that, right? That will also kind of help you determine in terms of where exactly do you want to stack up in this whole investing world, right? I think working on the tight timelines and handle pressure that just comes intrinsically along with this whole industry. And I think it's just easier said than done, right? So it's an interesting journey, I would say. And each one has its own set of course to be charted along the way. But my idea over here, and I'll just leave it at that because my idea over here was to provide you a brief snapshot and idea in terms of how is it that you can look at this whole landscape wherein you can chalk your path along this whole journey. So yeah, thank you so much for this, and I'm open to any questions that may be there.
Yeah, thank you, Naveli, for a very insightful presentation. In fact, we have quite a bit of questions already in the queue, so I'm sure there's enough time for people to key in more questions as we go forward. So I'll just sort of start with, from, if you look at the broader I would say the participant base or the people who have logged in, I would assume most of them would be either candidates who are pursuing, various levels of the CFA program, or people who have already done the charter and probably are working in some area in the financial services industry. So one of the common, I would say, the theme of a few questions that I've seen is your last slide did really give a very, I would say, a clear requirements in terms of the technical and the soft skill requirements in this industry. But the common theme is, say, for example, if someone were to move from, say, a public market into the private equity space, or in a different segment of the financial industry. So what are the, how does one actually get into the private equity VC space, and how does one go about it? I think that's been one common theme. So maybe we can just start with that before we get into the other questions.
Sure. And Rajiv, here I mean, I am assuming when they say getting into private equity and VC world, it's more to do with the investments, I'm assuming, right?
Yes, yeah, that's true.
Yeah. So I think so one of the slides I had mentioned about, so one is definitely if you can crack in early in terms of an analyst level itself, because most of these funds you should understand are very lean teams, right? Both private equity and VC have very, very lean structures in terms of the team structure and even the hierarchy. It's not a very corporate-ish like which wherein you have 10 ladders and stuff like that. So the earlier you get in, it just becomes easier for you to kind of grow through that as well, and easier acceptance because you understand the nuances of the whole investing world early on. But I think the other ways that one could look at would essentially be through maybe the allied services that I said along with the
Mhm.
investing, right? When you're working with a consulting firm, when you're doing a lot of these due diligence in the M&A space, where you're doing a lot of advisory service to an M&A, you might not really be doing that M&A yourself, but you understand, you start forming the facets of the investing world very soon early on. And I think that becomes an important lever for you to be able to justify yourself in terms of how is it that you can see and you are the best fit for a investing role in a PE or VC. So this could be either through your investment banks or your consulting roles in the different aspects, right?
Okay. Yeah. So maybe the other question, and again, which I'm seeing is, so in terms of decision making. So once you are in an investment role within a PE, within a early stage or a VC firm, and what are the factors that actually go into decision making in terms of selecting portfolio companies? So this, and I think again a related question there is, apart from the technical skills that you did mention, uh, how much of domain knowledge in that particular, say for example, if you're evaluating something in AI related area, or maybe even agri fintech, how much of domain knowledge is necessary for you as an investment professional to go forward? Or there in this case, do you rely on external consultants for industry domain knowledge, or it is something that you need to necessarily build up individually?
Yeah, sure. Thanks, Rajiv. I think this is this is essentially the question related to your evaluation. And when
Yeah.
you're evaluating, I think that is where your core responsibility is as well, right? Because as an investment professional, you have to evaluate in that particular segment and the sector. So you'll need to understand the nuances of it, right? So if you're doing a B2B kind of landscape, just a subtle thing of maybe the sales cycles are a little longer. But if your
Mhm.
sales cycles are longer, your LTVs could be higher if your product is actually a good fit. So those kind of subtle nuances and stuff like that will need to be something that you are apprised of, and you can't really rely on the consultants for that. They
Mhm.
are able to help you when you have actually a little more in terms of your investment thesis. You're more solid in terms of, yes, you want to go ahead with it and help you understand the other aspects of the risk. But just evaluating in terms of the sector that you're looking at needs, that's what your role is, right? Because
Mhm.
otherwise you're not really doing the role that you've been assigned for.
So when it essentially comes to new age firms, say if something in artificial intelligence, So there, given the sector or the industry itself is evolving, and there are so many developments that keep happening, and which sort of, so how does one be on top of it in terms of, getting a better perspective so that you are able to
Sure.
evaluate individual companies that come to you?
Sure. So I think that's where a lot of capability in terms of your networking and your
Okay. Okay.
reading makes a lot of sense, right?
Hmm.
One is because, especially when you mentioned about AI, all of this is evolving in nature. And right now,
Right.
I think we have just cracked the first phase of AI, and the AI has a potential to do a lot much more, right?
Hmm.
So, how can you be on top of that particular field, which is evolving in itself? So, it requires a lot of your intrinsic nature to be on top of things, to read a lot of stuff, see different kind of business models that are coming across. And AI can be for any kind of segment, right? It could be for your fintech, it could be for your healthcare, it can have use cases maybe across supply chains. And you need to understand the usability that AI can kind of bring in across the different verticals and try and understand the different business models that are coming in. Few have got invested, or why have they got invested? What was the investment thesis at that particular point of time? And also talk to people. It's more secondary and primary, right?
Right.
And that's where
Okay.
the soft skill of networking also helps. And believe me, in this world of today, people are more than willing to talk,
Okay.
even if you don't know them. Just a cold reach out over LinkedIn, etc., just to exchange notes. People are more than willing to help and talk about it because it's just sharing of ideas, etc.
Okay, that's interesting. So I think, let me just go into the deal life cycle that you sort of, there are a few questions on that. One of the questions that has come in is, how much of roles in this deals life cycle, how many of them are outsourced? I think it's something that has come in.
So I think I
Yeah.
had projected it that time, but
Okay.
essentially from your deal life cycle point of view, see, the investment team has to be on top of everything. That's
Okay.
the thumb rule. You, even if you want to use the word outsourced or not outsourced, essentially you're trying to use the ecosystem players to help you make better decision. Please think of it that way. It doesn't mean that if the thing is outsourced,
Hmm.
um, the work of an investment professional kind of decreases. So right from your deal sourcing, right? Because a person who is being able to help you, he gets a broader set of funnel. Half of it might not even fit your funnel, fit
Hmm.
your
Okay.
broader
The
investment
broader
thesis.
thesis.
So that's
Okay.
where your core capability kind of comes in. How are you able to navigate through that whole broader funnel as well, right from the start, to be able to fetch out what makes sense for you, and then have level deeper conversations, try and understand that a little better and stuff like that, right? So that was from a perspective of maybe deal sourcing. One critical aspect where a lot of external help is sought for is the due diligence process itself.
Hmm.
And due diligence process, I think, is such a critical aspect because it helps you highlight all the risks as much as possible earlier, and to make so that an investor can make an informed decision, right? And that's where an investment professional is working along with a DD professional whom you might have hired, so as to
Hmm.
be able to better be on top of those risks. And how do you kind of navigate that risk in your investment thesis, right?
Okay. Okay.
So this is essentially where this sits. And whatever said and done, the different firms can have different outsourcing at different points of time. But essentially, I think it's the fort has to be held by the investment team,
By the
right?
investment team. Okay. Um, so in terms of now, the structure of the fund, right? It's typically, they are close-ended in nature, right? Where you draw down money over a period of time. So there is one question as to, what are these Series A, Series B type of funding? I think that's something that has come in. So if you could just explain the nature of how you draw down money, and what is typically the timeline that you take to deploy, say, in a fund that is probably, say, a 10-year lifespan. And again, related to that, in a typical investment cycle, what's the hit ratio in terms of, how, you might be looking at, say, 10 to 15 or maybe even larger number of firms for investment, and typically how much, what is the hit ratio, and in terms of diversification, what is the number that you typically look to in your investment portfolios?
So I think a bunch of questions there.
Yeah, I just tried
And
to, because
and
you
it
got more than
is
40 odd questions. I'm just scrolling it
no,
as
no,
it.
fair, fair.
Yeah.
So bunch of interesting questions there. So maybe I'll just start with the basic question that people asked, I think, with regards to pre-series
Yeah.
A,
Right.
series B, etc. Right? What essentially this means is, so once I showed that graph in terms of you start with friends and family, then you move on to your angel investors. Once you start, once you need better capital in terms of for maybe project product market fit for your GTMs and things like that, what you would essentially need is maybe higher capital as well to kind of get inroads into market, right? So, and when you're reaching out to these institutional investors, depending on your revenue numbers, it can be pre-revenue, post-revenue, and stuff like that. You reach out to institutional revenue investors typically in a seed stage kind of a round. Seed stage will essentially help you grow to a certain extent, but it's a very important call, right? Because not a lot of people can take a bet on the seed stage itself because a lot of ifs and buts. Sustainability is a question. It's just, as I said, a lot of in terms of how the market is, your view in terms of that sector overall, and a call on the founder, right? But post your seed round, wherein you have been able to kind of get that capital, there could be two things that could happen. That seed round has actually helped you in terms of whatever that founder was essentially planning to in terms of his business or product, etc., is going in the right direction and is able to help him grow to a certain level of revenue, etc. Right? Or the second could be it's helping him to understand that this might not really be a right fit. He might need to make changes to his whole product or some certain changes. If it's a technology thing, some subtle changes or nuances that needs to be think about. His business model might need to be tweaked a bit and stuff like that, right? So there again, that needs additional capital for you to be able to do that. So that's where the next round of investment also kind of comes in, which will be either your seed extensions as we are seeing it these days, or it could be your series A. So typically in a series A, you're expecting certain particular threshold of revenue numbers have been reached. Some kind of GTM has been shown. Some kind of, business model is evolving, I would say. And those are again early stage, but a little more less riskier as compared to maybe the seed stage. But in order for you to grow, because essentially you're still loss making at the end of the day. So you need capital to be able to churn out what is it that you're doing, right? So that's why you keep going to the market in typically in 1.5 to 2 years time frame for you to be able to grow and chalk out your path. So that's why it leads to series A, B, C, D, and depending on different companies might have different growth trajectories that you might see that are available. But depending on your capital needs, based depending on the growth, the hunger that you have, depending on the capital intensive nature of the business by itself, right? Are you more of a software based, so your capital needs might be lower? Is it more in terms of is it a capital intensive business wherein you need a lot of plant investment, etc. as well? So their requirements might be different. But then that's where it's important that along with all your growth stage and later stage investments, a lot of debt capital is also brought in early on. So you are able to not the founder is not really diluting because it's easier said than done that you maybe just go out in the market in 1.5 years and you raise one more capital, right? But essentially, you really don't want to be in a situation where the founder is going into a series A, B, etc., and just holding 10%. So you want to be mindful of those parameters as well. And that's where I think that whole debt slide that I want to get into picture was essentially to dwell on the fact that there are other channels to investments and venture debt and private debt makes a lot of sense at appropriate points of time. And I think the next question was with regards to the fund investment lives in terms of years, etc. Right?
Yeah.
So a typical fund, say suppose if it's of 10 years, will have either 5+5 of investment period and exit period, or could be 7+3, etc. And there could be an extensions that the fund could say, but that's on a case-to-case basis. So typically in a fund investment period is when before that itself you would start reaching out into the market, scouting for a lot of deals, etc. And before your capital is ready, you at least have a good pipeline of deals with you to be able to evaluate that deeper and go and sort from an investment point of view before you're kind of going into an IC. I think that is where it lies. And so you would essentially start building your funnel early on. And once you have that kind of capital, then I think it's more procedural in nature, because you have to go to your IC, you have to make them comfortable. If you get an approval from them, then you follow your internal processes in terms of your risks. Risk team will have their own matrices in terms of how is it, and they need to get comfortable as well. Then you would go for drawdown notice. So those are procedural aspects, and where the drawdown notice will be sent to your LPs. You call in for money in with a certain point of time frame, and that could be used for essentially your deployment. And until that period of time, when all of this is being done, you're essentially doing all your CPs, which is essentially your condition precedent for your closing. And a lot of these CPs essentially comes from your DD, right? Because you want certain things to be kind of sorted before you have made that investment. So these could be either regulatory nature as well. Some industries have a regulatory thing as well, that these approvals may be needed from some particular ministry before that investment could be done. And these could be a bilateral agreement and a negotiation between the counterparty as well. So just from the point of view of getting a go ahead to a deployment can also vary based on, I would say, nature of the industry that you are in, the ticket size. The PE versus a VC will again have a different kind of thing. It also depends a lot on your LP base, if it's more domestic or international, or if it is institutional versus your larger pool of HNI clients. I think all of those kind of, it's a mix that kind of determines, right?
Mhm. And that question on hit ratio. So
Oh,
for every, if you could share, how many rejects could you typically have?
so I think, Rajiv, I think you will also know this one, right?
Yeah,
Even in the whole net space, I think
right.
that's a very tough one. We definitely evaluate a lot of these deals.
Mhm.
But hit ratio, so when the filter kind of always kind of gets narrower
Yeah,
and narrower, right?
yeah,
That's
okay.
how it is from
Right,
one
right.
stage to the other.
Okay, okay. Yeah, good. So you did mention about the role of debt capital in certain stages of a life cycle of a firm. But beyond the equity and the debt, is there any other capital structure such as preference shares or something else that are typically looked at? Because there was one question, I think, on that as well. Uh,
Sure. So preference shares, so when I'm saying equity, equity could have any nature, right?
okay,
Equity,
yeah.
I'm saying, is not really just pure equity. It could
Mm-hmm.
be in your form of your CCPS, it could be in your form
Yeah.
of CCDs, it could be preference shares, etc. It could vary. And
Okay.
that's what I was alluding to when I mentioned earlier on in the slides as well. In terms of a lot of external consultant help could also be sought
Okay.
at that particular point
Mm-hmm.
of time. And
Mm-hmm.
how is it that you want to structure your deal?
Mm-hmm.
Because the investment team by itself might not be well versed, and that's where a lot of collaboration on the ecosystem is needed in terms of choosing the right instrument for investment, because it depends if it's a priced round, unpriced round, what is the best way to kind of risk mitigate yourself as well from the follow-on rounds, etc. Because that might have a lot of tax implications as well. Is it an
Okay.
underpriced round?
Mm-hmm.
Anti-dilution might kick in, and a
Mm-hmm.
lot of bunch of stuff that you will need to kind of think through. So that's what I meant by the different kind of equipment, the instruments, etc.
Okay. And in terms of exits, what are the routes that we typically look to when you exit from portfolio companies? And again, related to that, if you could give a range of the IRR or the target return that is typically sort of like your benchmark.
Sure, sure. So I think exit, I think from an debt investor point of view is a little more different as compared to when you're looking at it from an equity standpoint. But from a VC standpoint, if I'll just bifurcate this between
Mm-hmm.
VC and PE,
Yeah.
but VC can have two routes of exit primarily, right? One is essentially once the company, so investor who's coming in early in terms of seed or series A round, will essentially work towards the growth of the company, and then your follow-on investors would kind of kick in, which is your growth investors. At that particular point of time, you could either have just a primary round, or you could have a secondary round, or you could have a mix of primary and secondary, right? So these kind of rounds will essentially provide either partial exit or full exit to your early set of investors. That's one of the essential routes for you to exit. And the second route could essentially also be with regards to just a strategic buyout. If you're growing, and this typically happens a lot in abroad, right? When you're
Right. Right.
talking in India, I think it's a little less prevalent. I
Mm-hmm.
think that momentum has still to pick up. But if you're actually growing, and if it makes a lot of strategic sense and synergies for an existing bigger player, he would just absorb. So
Mm-hmm.
that's what we have seen in a lot of other bigger companies, right? So buyouts is essentially, strategic buyout is essentially one of the other key ways for you to be able to have your exit.
Mhm.
What kind of exit, etc., is a different, but for you to be able to have an exit. And the PE stage, in the growth stage, again, a growth stage can be maybe it's leading up to your IPO, or it
IPO.
could be leading up to maybe a secondary buyout
Mm.
by a private equity investor. But similar, right? Even in your PE scale, you would look at either your IPO. That's where a lot of pre-IPO funds have also come, and they also help
Mhm.
in the exits of maybe your growth stage investors, right?
Oh. Mm.
So pre-IPO rounds, etc. But essentially, you look at an exit either from a senior investor who's kind of coming in that stack table, or from your IPO markets. Or there could be a strategic investor there as well who could just come in and kind of buy out at that particular point of time. So that's how you look
Okay.
at exits.
Yeah. And the range of target returns that you look at
So I think that really, really varies across the
varies.
whole spectrum.
Uh-huh.
Really
Okay.
varies, right? So maybe
Mhm.
your late stage investors could be somewhere around, and please don't hold me for this one, but
Oh,
it
no, no.
just varies in terms of
Mhm.
they might look at 15 to 25-ish percentage types, but your early stage might be looking at much higher
Acha. Okay.
IRRs, 50 plus
Mhm.
and stuff like that, 40, 50 plus,
Mhm.
depending on which stage they are coming in. But I think as a professional, what is also important is IRR is a function of time. Please
Right. Right.
always have a view in terms of your MOIC as well, because MOIC is also an important lever. It does not account for your time, but your just an early exit might give you a good IRR, but not meaningful return in terms of your MOIC. So just have, I think an investor and especially an investment team needs to have a better sense in terms of just the right collaboration between both.
Okay. Maybe we have time for a couple of questions more. There's one interesting question that I just saw on the chat. So it's regarding how much of involvement do PE and VC firms get involved in terms of in terms of management and business strategy of the businesses that they have invested in? So how much of hands-on, I would say, oversight do PE/VC firms do typically? Are they involved at the board level, or are they really hands-on in terms of running the companies? I think that's a question that has come in here.
Okay. No, interesting that question came up, but essentially, you are not really you're not really hands-on on the business, right? Because that's
Hmm.
the work of a founder. And you have taken a bet on the founder.
Hmm.
You are not going to be replacing the founder. You're betting on the founder that he'll be able to deliver on what is it that he has promised to you as an investor.
Right.
But your uh, interaction or your discussions with him could vary with
Hmm.
regards to maybe just a quarterly board meeting to
Okay.
maybe a little more in terms of early stages. What happens is you're on a monthly basis, you are in discussions with them, just trying to see that this was the strategy was not really working. We had discussed something else that last time. Is that kind of working? You would kind of build a thesis out and help him chalk through that journey. As compared to on a day-to-day basis, you're kind of getting deeper into it. And it also depends a lot on the founders as well. Sometimes the founder is more open in terms of asking and seeking for help. So there's only so much that a particular investor can also help, right? So it
Hmm.
works both ways.
Okay. There's a macro sort of question now. Of course, anecdotally, we do hear that given how globally interest rates have moved up, has that really impacted the fund flows into this space? And again, given the way the dynamics have changed on the macro side, have the expected returns also gone up from the investor side?
It's an interesting question, right? And especially because ultimately it's the interest rate that kind of walk you through your charting your strategy as well, because you are promising some particular returns. And as an LP, I mean the investor who's actually putting in the money into your fund, he's also like kind of chalking out, right? And that if I'm able to make X particular percentage in the US G6
Mm-hmm.
versus investing in India exposure, and that too in an early stage, he would benchmark it to some particular percentage of return. So I
Right.
think the movements of your interest rate would definitely, it does impact a lot in terms of your fundraising capabilities, because the whole picture that a foreign institutional investor might see from geographical allocation to maybe Asia and specifically to India might change as compared to maybe the lower interest rate regimes. So from that standpoint, from an international standpoint, it does impact to that particular extent. But as a fund, your returns could, I wouldn't really say, but it depends on fund to fund. But
Okay.
that's why it's a range, right? Nobody promises a particular fixed percentage.
Okay. Last question from my side. So, how big is impact investing in India, and do we have funds with that mandate? And do you think that really picks up going forward?
Oh, absolutely. I think one of the core themes that's been coming up now has been the impact theme, right?
Okay.
And by impact could be any ways. It could be through your all of this ESG with regards to your environmental services, how your societal impacts that you have in your society, tier two, tier three, and stuff like that. And impact, I think, is becoming a much more core theme as well, to the whole investment fund. And that's where I think quite a bit of funds as well, from their own investment thesis standpoint, uh, are betting away. No, I wouldn't say betting away, but the whole investment thesis is maybe moving away from the non-impact sectors, with all due respect to them, right?
Hmm.
But we have seen more and more funds, and we ourselves also look at a lot of these impact core
Okay.
themes of investments. But I see more and more of it actually as we go forward.
Go for. Okay. So
Yeah.
that's
And
going to
this
be
is
main.
also a theme that's actually encouragingly coming from the founders as well. I think that's where the
Oh,
whole thing also lies, right? Because in the ecosystem, it has to
okay.
be conducive.
Okay.
Because the need of the hour, I think, as people have been understanding, and the language of the founders have also been changing increasingly, is what I'm seeing.
Okay. Okay. Interesting. Yep. So thanks a lot, Naveli. It was a very insightful session. Thanks for sparing your time and giving very detailed explanation, and and for
Thank you
taking
so
the
much, Rajan.
queries that have come in.